this is Abhijit Chatterjee. Welcome to our weekly session of Chartsarefun. This is for the week of December 8th, recording this on Saturday evening, the December 13th. Today, we're going to talk about the FOMC decision. There was the 25 basis point rate cut as expected, but a bit of hawkish move with FOMC sharing their dot plot projections, showing only one cut in 2026, another cut in 2027. However, what the market didn't quite pay attention to, but the risk assets have been giving signals since that decision was the $40 billion of T-bill purchase that the Treasury started. This was a bit of a surprise. Market wasn't expecting that. Not that there was an immediate need, but looks like there's a liquidity issue and the market, the Fed decided to introduce T-bill buying. So if you remember, the QT had the quantitative tightening where they were offloading a ton of treasuries and mortgage-backed securities in the balance sheet. They were reducing that. Then they ended that at the beginning of the month in December. And starting last Friday, starting yesterday, December 12th, they started their 40 billion per month of short-term T-bill purchases. So this, they claimed, Chair Powell claimed that this was with typical tax season. By April, the revenue from the taxes don't come in till mid-April, so they wanted to do this to give Fed good amount of flexibility for liquidity for them to be able to fund. That said, we know that this is going to bring in fresh cash into the market. There's going to be now money looking for riskier investment opportunities because there's going to be fewer short-term T-bills. The T-bills are going to be gobbled up by the Fed. As a result, money will start moving into riskier assets. So we'll look at that and talk some of the key impacts of that from risk assets. We'll look at from a crypto perspective. We expect that to be a beneficiary. In particular, Ethereum has been outperforming Bitcoin, so we expect the Ethereum and altcoins could do better in the next several weeks. Also, small caps, which are a huge sign of liquidity-based move, broke out, and IWM in particular broke out to new highs. So we'll look at that chart. And then we will also look at QQQ, of course, because of the AI trade last week. There was a big bombshell from Oracle on Friday saying that they'll have to delay some of the rollout of the data center for OpenAI into 2027 because they have to raise funds first and more of raising the capital to then be able to, roll out the data centers for OpenAI, and also in some ways, getting the energy and the infrastructure in place for that rollout. And then we will end with something very interesting on the 10-year treasury. It's at a key resistance level at 4.2. So 10-year yield, treasury yield at 4.2 would be able to break that higher. That would be very bearish. But if it does not and fails, and maybe with the quantitative easing that Fed's invoking, maybe it leads to it failing at the 4.2 and resuming its decline, and that would be very bullish for home builders. So we'll look at the home builder ETF, S&P home builder ETF XHB. So with that, this is our Substack site, chartsarefun.substack.com. We appreciate you subscribing to it. We email it to you as soon as it comes out around 7 a.m. every morning. Our YouTube site is also Charts of Fun. Hugely appreciate you subscribing to it. And if you like the videos, hitting the like button. And let's go straight into Barron's wrote an article this weekend that this idea of Fed buying billions up to 40 billion every month in T-bills. Chair Powell did say that this is going to be up to April, and then they may bring it down to 20 to 25 billion to keep the money needed on the reserves. But they're just not calling it QE. They just don't want to give market a bone, thinking that, oh, QE is starting like we saw in 2021, so now it's time to party. But that said, the market is smart enough to know what they're after. They are, in the end, supporting risk on again. And what's the risk on? So some of the signals, this was an interesting street.com article. Silver pushed to broke out. Silver is anyway climbing, but it kind of capitulated higher, hitting 64 dollars an ounce. It was in the low 60s, jumping up to 64 and then pulling back slightly on Friday. So silver is the riskier asset than gold among the precious metal, and that kind of hit all-time highs. Gold is yet to cross its previous highs, but silver hit all-time highs on right after the Fed move. Ethereum is outperforming Bitcoin. We'll share that as well. That's the riskier version among the cryptos. So Ethereum is outperforming Bitcoin, and then small caps, which is a kind of a classic signal of risk on with money piling back on from speculative. A lot of these Russell 2000 small cap stocks we know are are not even profitable. A lot of them are speculative, and that kind of breaking out is another indication of money now seeing liquidity pump risk on or pump risk-taking assets. So let's look at the chart of silver. This is a daily chart. We blogged about it. We think this is kind of long in the tooth. It's already met its cup and handle. This is kind of a cup from 54.49 in the left brim to 55 to 45 up to 54, then another kind of a cup-shaped handle, and then the breakout. So if you do a 45 to a 54, that's $9. Add that to 54, 63, 63.25 to be precise. It exceeded that, hit closer to 64.31 cents, and then closed below that target at 62 bucks. So there was a pullback, $1.53 pullback on Friday. And that's where silver ended. However, look at how extreme the MACD is stretched out. RSI in this particular case is at a lower high, which is a negative divergence. And we believe that, look at how far it is stretched from its rising 200 period moving average. We believe this is actually a time to start looking at ZSL, which is 2x leverage short of silver. And ZSL is a great ETF to play reversal move in silver. This is kind of already, very stretched out, has gone parabolic, and we feel that silver could now have a pullback as money may move out of silver into other opportunistic assets, maybe into cryptos. So money out of precious metal into cryptos could be the play, because at the end, money seeks where the momentum is, and momentum may now shift from precious metals, from gold and silver into cryptos. Now, in the crypto space, an interesting chart of Ethereum. This is the spot Ethereum ETH USD ratio to the Bitcoin BTC USD. We can see that that was declining, as in Ethereum was underperforming Bitcoin from that August peak all the way down to more recently into November, and then from there basing out and then beginning to climb. We can see that there is a climb happening. We can see RSI's climb back towards 70, MACD is trending higher, indicating that relatively Ethereum has now begun to outperform Bitcoin, which is again a risk on kind of phenomena as highlighted here, Ethereum outperforming Bitcoin. So now where could the Ethereum chart take us in the near term? We find a beautiful ascending triangle. If this does pan out, bears would call this a bear flag. And that's, from their perspective, you could say that a huge decline from 4,900 to 2,600, then kind of a flag formation, and that breakdown from this flag below the 26 could take it a lot lower. So that's what the bears would call it. But if this pans out to be an ascending triangle, and with the liquidity that FOMC is pumping in now with 40 billion T-bill purchases every month, this breakout from the 26 to the 34 is 8,000 added to 34. That's up to 42,890, close to 4290. Above this level here at 4253. So 4,200 to 300, 4,200 to 4,300 is where we think Ethereum could break out to, and we've got to watch this in the next week or so to see if it is able to muster a bounce, break that 34.55 resistance, and above its 200 period moving average at 35.59 and climb towards 4,300. That's quite possible. Now, Bitcoin has a similar ascending triangle formation as well, a reversal pattern, higher lows, and kind of a key resistance level at 94,600. The low was at 80,600. That's exactly $14,000, the depth of this triangle. At 14 to 94,600 is 108,600. Where is that level? Exactly at its 200 period moving average. Look at where the 200 period moving average is. 108,675. So 108,600, we believe a little above the previous resistance at 107,500. So anywhere from 107 to 108 is where we think Bitcoin could be headed if it breaks out of this ascending triangle. In a similar way, the bears would call this as a bear flag. You'll be seeing many YouTube articles you see out there calling for that. But what people are missing is Fed just gave a liquidity pump signal. Fed just gave a risk on signal to the investors to start looking into buying money in. Now, they might have done this in anticipation of a risk factor that many are talking about, which is Bank of Japan raising their rates by 25 basis points next Friday. This is on December 19th. There's been fear because the yen carry trade that if this happens, there's going to be less of free or cheap money out of Japan moving into US, and that could in some ways further kind of reduce the risk on buying appetite for US assets. So maybe Fed did that in anticipation of that. Maybe what people are not talking about is Fed saw the risk coming from Bank of Japan's rate hike, and because that's been telegraphed and investors were being concerned, they basically negated that with their liquidity pump of 40 billion a month to effectively say that we are out there now to kind of provide you. Though they're not calling it a QE, this is QE back again. So in principle, what happened in early 2021 when cryptos took off, when the QE signal came, a similar environment is happening off where we feel that Ethereum and Bitcoin could both break out of this ascending. It's late to react. It didn't quite immediately react as we saw in Ethereum, in silver or small caps, but it could just be something for us to watch next week. Now, small caps ETF IWM, this is the Russell 2000 ETF. We can see on Friday it did have a pullback. This was again the AI shock from Oracle's news. Overall, the market had a pullback, but previous 2 days on Wednesday and then into Thursday, this is the Fed move came on, 2 o'clock on Wednesday, and then into Thursday, small cap broke out above a key level at 250 to 253, and then it touched somewhere towards the 250. If you just hover around this level, it touched a high over 258. It tested 258 again on Friday and from there pulled back lower. Now the key level for it to test is the breakout level at 252. We'll see if it fails below it. Even if it fails below it, we had last week drawn this pattern that if you look at an inverse head and shoulder, a potential move down towards 240 cannot be ruled out. Well, it could be that we could get a little more downward momentum into early next week and maybe retest that rising 50 period moving average at 245 and from there revert higher. But this move is very much a risk on move that the market immediately took off after Fed's QE announcement. And if you look at a longer term, as in slightly earlier in the year, not so much longer term, but slightly earlier in the year, if you look at the cup and handle from 228 as the left brim, came to 170, came to 226 on the right brim. So 170 to 226 is $56. At 56 to 226, you're getting a straight 282 target. So 282 is where IWM's cup and handle is measured. So if we look at this inverse head and shoulder, a move from 228 all the way up to 253, that's roughly, you're talking about 228 to 253 is you're talking about say $25 or so. So 25 to 253 is 278. So that's in that ballpark of the 278 to 282 is where we think IWM could be climbing to. Something for us, we can see MACD is now very much in the positive territory above the zero. Signal line is climbing. RSI is also kind of not broken down back below 50, has been climbing and touched towards 70. We could resume strength, and this could be risk on mode, taking IWM towards that 275 to 282 or so level. QQQ, interesting enough, this is the 2 hour chart, is also formed a cup and now a handle pullback. It formed a left brim somewhere around 626 to 580 up to 629. So 580 to 629, you're talking about roughly 49 points. At 49 to 629, you're talking about a 678 as the target on QQQ. So this could be a handle forming. We have to see, and this pullback that we saw on Friday was primarily that AI driven concern from the market that who's going to power, who's going to fund all this capital expenses. Now the mega caps, like call it the the all the large Googles and the Microsofts of the world have tremendous positive cash flow, tremendous profitability, so they could power their capital expenses, Meta, all through their cash flow. But Oracle is not in that situation. They are struggling with raising debt, having to, and their CDS swaps, the credit default swap rates have shot up, indicating market is concerned. Is Oracle going to be able to pay for the huge capital expense that they're going to about to roll out? Now, Larry Ellison is extremely bullish. He thinks he's going to be able to raise the capital, and maybe with now flush liquidity that the Fed is introducing, maybe they're coming to Oracle's rescue. Maybe they're coming to the AI scenario's rescue and providing the liquidity. And if that happens, of course, Oracle is going to shoot up. Right now, sentiment in Oracle is very bearish. It's pulled back a lot from its peak when it touched in October when they announced this huge kind of 5-year spectrum of strong revenue that they are going to be able to recognize through AI build out for OpenAI primarily. So market was bullish, but then all of that kind of dissipated. They pulled back and back to from where it started in the $180 level. It came back to retest that last week with Oracle's earnings, and then with concerns that they have to raise debt to be able to fund that investment. So that said, if any of that gets kind of sorted out in the weeks ahead, this could be a contrarian move and also a seasonal move, a Santa Claus rally after all, getting us into a peak sometime in the January timeframe. So that's a possibility, is this cup and handle. If this doesn't break down and we are not back towards the below 600 towards 580, then of course that's a very bearish sign. And many are actually calling it a head and shoulder, with the left shoulder at 613 down towards 589, the head at 637 to 580. This is the right shoulder higher than the left shoulder at 629. And now people are calling this as a breakdown. If that's the true, then a breakdown from 580 to 637, you're talking about $57 subtracted from 580. 57 subtracted from 580 takes you down towards close to 523 or so. So that's where bears would be looking for this breakdown to take. But we think there's a very good chance, with the Fed's injection of liquidity and risk assets now beginning to do well in the near term, this cup and handle on the 2-hour chart could break out higher above 629 towards that 678 target. That's what we think. Finally, the 10-year yield, if you look at the horizontal line here drawn at a very key support, which is now resistance. It used to be support at 4.2 in the earlier part of the year in the summer time frame. So it shot up to 4.62 or 4.63, came to 4.2, again 4.4. So that's a descending triangle. A descending triangle where there are lower highs and a horizontal support line at 4.2. So a 46.29 to a 42.05, you're talking roughly four, four, about 4 in terms of the TNX value, but it's 40 basis point. It's 4.2 to 4.63. So 4.2 to 4.63 is roughly 43 basis points. Subtract that from 4.2, you're talking about a 3.77 handle. 3.77% is where this measured target is. It didn't quite get there. It actually came to a 3.99, came back to the 4.2, tested it. Then it came to the 3.94, 3.95 level, back to 4.2, 3.898 up to 4.2. This is an inverse head and shoulders what the bond bears are saying, as in they feel that higher yield, higher 10-year yield is coming. Because if this breakout happens from this inverse head and shoulder, a 39.47 to a 42.04, you're talking about roughly 3.57 added to 42.04, you're talking about 43.61. So 4.36 is where bears would looking for yields to climb up to, and that would not be good for the market at all. But if this turns out to be a key failure at this resistance and a resumption of the decline, that would be very bullish for home building stocks. And guess what's happening? You got an inverse head and shoulder both on the 10-year yield and the home building stocks, which are actually inversely correlated. Home building stocks do well when long-term yields come down, when 10-year yields come down, not when they go higher. So either of these two patterns, one has to resolve. If this inverse head and shoulder happens on the 10-year yield, then this will fail and we're going to have a resumption of the home builder decline. However, if this fails and the long-term yield, the 10-year yield starts coming down, this is going to have a nice, good breakout. And that breakout on the XHB, which is the Spider S&P Home Builder ETF, is anywhere from 98.66 to 110.3 or so. That measures to 122, 121, above the peak we saw in early September at 120.41. So that's, if you notice, that peak in early September was also the time when we kind of had a yield kind of bottom out, and from there yield has been basically trending higher. Because remember, after the Fed cut in September, long-term yields started climbing higher. So that is why home builders started kind of, topping out and moving lower. But instead of breaking down and going all the way to the April lows at 84, it actually kind of held a key level at 98. From there formed an inverse head and shoulder. So if the risk on environment is on, there's a very good chance the 10-year yield could fail here at 4.2, break lower, and that could imply here we could start seeing a climb of the home builders XHB. So that's what we are expecting. So in summary, we have Barron's talking about Fed starting its QE. They're not calling it QE, but it is QE. It is a form of bringing liquidity into the market. They're buying 40 billion of T-bills for the next few months. There's a great article on thestreet.com talking about indicators of where that risk on environment has gone on. Silver pushing towards all-time highs, which is a riskier version of gold. Ethereum outperforming Bitcoin, and Russell 2000 small cap ETF breaking out. So here is the silver chart. We see that big breakout from this cup and handle. That measured target was $63.25 an ounce. It exceeded that, hitting 64, but then on Friday pulled back. This could be start of a decline because it has diverged a lot from its rising 200-day moving average. We'd be careful on silver. This is not the time to buy silver anymore. We believe money is going to move out of precious metals into the cryptos. So we think that way to play this pullback in silver is to buy ZSL, which is a 2x leverage short in silver, and that could see decent upside as silver pulls back. And Ethereum relative to Bitcoin was declining. However, recently from December, we can see an upward trending ratio chart of Ethereum ratio to Bitcoin. So that indicates Ethereum could outperform Bitcoin in the next several weeks. The Ethereum chart shows us a beautiful ascending triangle pattern. Bears would call it a bear flag, but we think potentially this is a bullish pattern. Higher lows, key resistance level at 34.55. That breakout measures 242.89. That's closer towards where we saw in the previous breakdown from October high at 42.53. So that's where 42 to 4300 is where we think Ethereum could climb to. Bitcoin also has an ascending triangle. That key level breakout above 94,600 from a low at 80,600 is $14,000. Added to 94 is 108,600, exactly where the 200 period moving average is, as we can see right here in red. So that's where Bitcoin could be headed to. Small caps had a beautiful breakout. We've seen a cup and handle from earlier in the year that measures to a target at 282. Near term, there's also an inverse head and shoulder. That breakout measures towards 278. So there is potentially a possibility that IWM, the Russell 2000 ETF, could continue climbing towards that 275 to 280 target. QQQ is kind of on its 2-hour chart. Every candle here is 2 hours, forming a bullish cup and handle pattern. The pullback we got on Friday was from the scare of AI funding for Oracle and how would they be able to, because they delayed their rollout of the data center for OpenAI into 2027. And market reacted to it negatively, but this could turn out to be temporary. We know that Fed is injecting liquidity. Risk on environment could push markets higher, and this could then be a nice cup and handle breakout of the Santa rally comes after all. And that measured target from a 580 to 629 is $49. At 49 to 629, that's 678. So that's our target on QQQ in the next few weeks. And 10-year yield is at a key level of 4.2. If it fails here, that would be very bullish for home builders, which is also formed an inverse head and shoulder. Being inversely correlated, Either of them cannot pan out at the same time. Either this breaks and goes lower, and then in that case, the home builders inverse head and shoulder breaks out. That home builders inverse head and shoulder breakout measures to 122, which would be a nice move higher in the home building stocks. With that, good luck investing. We'll talk to you next week.